Hey everyone, welcome back to my channel. Hope you and your portfolios are doing well. In today's video, I'm going to give you an update on my Roth IRA account, and I'll talk about how I mitigate volatility in my high yield income portfolio, what market data might affect my portfolio in the next few weeks, and what's my playbook for April. Okay, so starting with mitigating volatility, you can see that my portfolio has a few months of green, a few months of red, and recently has been green. But if we look at the last 4 weeks for the portfolio movement, you can see that in blue, it more or less keeps up with the S&P 500 and granny shots. And just recently, it's been, in the green. And one reason why is because of my portfolio allocation. Now, if we look at my first holding, which is SCHB, this is not an income ETF, but its main role is to anchor their portfolio and to help it grow in the next several years. Now you can see that this makes up about 50% of our portfolio and sort of what I call like a safe fund. So even if the market is really red, this market or this position will sort of keep me in the game without dragging the portfolio too down. Like other people who have only high yield income ETFs in the last few months were probably really red. And I'm not saying my portfolio wasn't red, it just wasn't as bad. Now, if we look at my first income ETF, which is HOW, and that has exposure to Robinhood, it did pay out pretty good, about $215.21 in March. And although my portfolio has been down the last few months, I continue to get distributions. I can reinvest it in positions like HOW or SCHB and also just save some for cash. Now, this makes up only 25% of our portfolio, although recently it's more because Robinhood has done pretty well in the last several days. But ideally, you don't want a high yield income ETF that takes up too much of your position because if some bad news happens or something happens in the economy, too much allocation on a high yield income ETF can really drag down your portfolio. So I'd say 20 to 25% is okay for my portfolio. And for my last income ETF, same thing. It's about 25% of my portfolio. Now, if we look at the income summary, you can see that January was pretty high and then February pretty low. And in the last month, in March, it's about 35% higher than in February. So I'm really happy. Year to date, so far, I received about $952. So nothing to complain. That's sort of passive income, and I can help, save some cash and then redistribute it to other positions in the next few weeks. Now, if we look at individual holdings, you can see that it's really green. If you've seen my previous videos in my Roth IRA series, you can see that it's usually pretty red except for SCHB. Now, if we look at SCHB, up 15.89%, really happy with that position. And you might be thinking, wait, why do you have PLTW? I thought you had QDT. And I did, but in the last week, I sold it because I saw a really big dip by Palantir. And so I thought, oh, maybe PLTW would be kind of a good asymmetrical bet because it took such a big dip. And I thought I could take advantage of that dip and maybe use this as a swing trade in the next few weeks. So that's my plan for PLTW. For HOW, again, this position was red for the last couple of months, but this month has actually done pretty good, and I'm up 6.69% in total profit. And overall, not bad, up about 23% or about $3,500. So I don't know if we're going to stay green for much longer. If you look at the news, we've had like 13 days of green. So I'm expecting a little pullback in the next few days, but we'll see. Now, looking at how market data might affect my portfolio in the next few weeks, let's first look at some seasonal patterns. Now, generally speaking, April's a pretty good month for the S&P 500 and the Nasdaq 100. And if we look at the last 10 years, starting from 2016 to 2020, all 5 years has been positive. Now, in the last 5 years, from 2021 to 2025, you can see that we did have some pull downs. From 2022 is a really bad year for most of us in the market, and also 2024. So 7 out of 10 years have been positive. And so generally, April's a pretty good month. However, during midterm election years, it might tell a different story. And if you remember watching some news and other YouTube channels, depending on how January performs, that might actually mirror how the rest of the market will perform in the year. Now, during midterm elections years, it's usually down, on average. And you can see that on all other years, it's just up and to the right. Now, if we look at April and May, both midterm and non midterm election years look like they look pretty good in April. It's just recently we've been in war. There's been some uncertainty and some other macroeconomic news. So April has been kind of up and down all over the place. But you see that generally it should be okay. But what worries me is if you look at between April to June, it looks like it's going to go down. Now, of course, this is just past data, and we don't know if that's going to really happen in the next few weeks. So I think it's good to just really have a little cash on the side, which is what I'm doing. So green or red April. And that really depends on a lot of factors. I can't cover all of them in this video, but just some that I'm looking at right now. Okay, so what might affect the market and my portfolio in the next few weeks? Well, earning seasons. Now, earning season is coming up or already has started. Some really big names are coming up in the next 2 weeks, and other people will be looking at some what we call bellwether type of companies, and they kind of give you some hint or insights to the health of how the market or the economy is doing. Are people sending out parcels? Are companies like Caterpillar still building homes? Are people shopping at Walmart, and are people keeping their jobs? Or how is JP Morgan doing? As well as things like even high luxury brands. All of their earning reports and guidance may actually tell the consumer or the investor what to expect in the next few weeks. So I think people are paying attention to these kind of companies. Also, with the IRA flush, now last week was the April 15th deadline, and most people have some sort of automatic withdrawal to deposit into their Roth IRA, but a lot of people still have not maxed out their Roth IRA account. So there's usually a lot of people who rush into the market to hopefully try to pay or maximize their Roth IRA account. So we call that the IRA flush, and maybe there was a little bit of more money circulating in the system. But there's no really good data on that. This is just kind of what some people say. Now, finally, a lot of the market really depends on executive decisions in politics, especially from the president. And the market really doesn't like uncertainty. So you can see that when there was some more clarity on the end of this Iranian war, you can see that the market actually ripped. And it might even go higher in the next week. Okay, so what's my April playbook? Well, before we get into that, just a disclaimer, remember this video is for entertainment purposes only. It is not intended as financial advice. Please consult with a qualified financial advisor before making any investment decisions. Okay, so earlier I said that I got rid of QDTE, and I'll tell you why. When I look at other funds, and I have made a video on some of these positions in the past, you can see that between EGI, QDTE, and QQQI, it's actually the loser. And my initial bet was that because it's been down so much, that it's probably a higher chance of reward. But actually, I was wrong. And in the last few months, QET has just really been underperforming a lot of other funds. But one reason why I thought QET might be good is because although it's not as high in return as other positions, maybe the dividend distribution will be stable. But in fact, when we compare it to other funds, it hasn't been stable, hasn't really recovered as much. I mean, if you look at the distributions in January, February, March, 52 cents to 70 cents just doesn't seem very consistent. Whereas Eggy, 87 cents, a dollar per share. Like, I think I need more of that type of consistency in my Roth IRA account. So that's one reason why I got rid of QDTE. I'm making a swing trade in PLTW and then waiting to invest in other funds. And some funds that I'm looking at are QDVO. And I did talk a little bit about this in previous videos, and I need to take a deeper dive. But I recently looked at Market Chameleon, and at first glance, when you look at the distributions, you'll say like, oh, 24 to 25 cents per month. That's not a lot. I mean, you might as well just invest in something like JEPQ or GPIX, right? But when I look at the change like year over year, you can see that the distributions have actually increased. And what's more surprising, if you look at the yield, and I might be reading this wrong, but I mean if we look at October, 8.63%, and then every month afterward, it's just been increasing and increasing. So I'm thinking, man, this might be actually pretty good fun to invest when the market is kind of taking a dump. And I'm kind of regret not investing in this when QDVO took a dip to $25. It's back over $28, so I'm really going to pay attention to this fund and try to invest into it in the next few months. So here's my April plan. Reallocate funds to PLTW for a swing play or a swing trade. And number two, my HOW distribution strategy is I'm going to use 50% of that to buy shares of SCHB and maybe QDVO. And the other 50% I'm going to save in cash. Now, why am I saving in cash? Well, I don't think the market is done with being red. And I know everyone is really positive about it being green, but the market just doesn't go up all the time. So when I look at this chart of SCHB, which also kind of looks similar to the S&P 500 chart, you can see that the last all-time high was around $23.75. And right now I think it's around 26 to $27 right now. And I thought it would dip a little bit more in February, but it never did. So what I'm waiting for and what I'm going to use the cash for is if we do take a dip under $24 in the next few months, my cash is going to go there. And if it takes a dip under 23, I'm going to load up. I don't really care if it goes below 23 or 22, but if it goes somewhere in between those red lines, I'm going to use my cash and put that in SCHB because I believe SCHB is going to be higher in the next 10 years than, 23, 24, $25. So that's my big bet for SCHB. Okay, so that was season two, episode number 6 of my Roth IRA series. Hope my portfolio update was a good one. And I know not everyone has a Roth IRA account, but I'm just showing how high yield income ETFs work in a Roth IRA account. And just remember, one reason is I don't have a lot of earned income from the US. So I'm relying on my high yield income ETFs to generate income within my portfolio to buy more shares of my core holding, SCHB. So that might give you some ideas on how you can invest in your Roth IRA account. So if you like this video, please like this video and subscribe to watch more free content on achieving financial freedom and living in Asia. And you might also like these two videos. Thanks again, take care, and see you in the next video. Peace.